You can start investing online today with just $100. And yes, even small amounts like that can grow meaningfully over time if you choose wisely and stay consistent. Today, I'm going to walk you through 5 realistic ways beginners in the US can invest that $100 right from their phone or laptop, compare how they actually performed over the past 4 years, and help you decide which one might be the best starting point for you. We'll judge each option on 5 simple criteria: how easy it is to learn, the learning curve, how much passive income it can generate, how tax-friendly it is, how risky it feels, and most importantly, what $100 invested 4 years ago would be worth today. Quick note before we start: I'm not a financial advisor. This is educational only. Past performance doesn't guarantee future results. Always do your own research and consider your personal situation. All right, let's dive in. First option: buying shares of individual companies. Learning curve high. Picking individual stocks isn't like picking lottery numbers. To do it well, you need to understand a company's revenue, profits, debt, leadership team, and industry position. That takes time, often months or years to get comfortable. A beginner-friendly way to practice is using a brokerage app that offers paper trading with fake money. You can experiment without risking a cent. Passive income potential, good. You can earn in 2 ways. The share price goes up and you sell for a profit, or the company pays dividends, cash payments usually every quarter, and you keep the shares. Not every company pays dividends, but many large, stable ones do. Tax efficiency, very good if you use the right account. In the US, opening a Roth IRA or traditional IRA lets your gains and dividends grow tax-free or tax-deferred. Many beginner-friendly brokers make it easy to open one. Risk level high. One company can struggle, get sued, or lose market share. If you put your $100 into only 1 or 2 stocks and something goes wrong, you could lose most of your money. Diversifying across many stocks lowers risk, but picking winners is hard. Real-world example from the past 4 years. Imagine you randomly picked one well-known tech company's stock with your $100 4 years ago. Depending on which one, results varied wildly. One example might now be worth around $68, a 32% loss, while a strong performer could be worth $170, and an exceptional one might have turned $100 into over $900. Lesson: stock picking can deliver huge wins or big losses. It's exciting, but requires research and tolerance for ups and downs. For beginners, it's usually smarter to start with only a small portion of your money here while you learn. Second option: real estate investment trusts or REITs, companies that own and manage income-producing real estate. Learning curve, moderate. You don't need to understand mortgages, property taxes, or tenant repairs. You just need to grasp that a REIT pools money from many investors to buy office buildings, apartments, warehouses, or shopping centers, collects rent, and shares most of the profits back as dividends. Passive income potential, excellent. By law, REITs must pay out at least 90% of their taxable income as dividends. Many pay quarterly, giving you regular cash flow without selling your shares. Tax efficiency, very good inside a retirement account. Dividends and gains can grow tax-free or tax-deferred in a Roth IRA or traditional IRA. Risk level medium. REITs own many properties, so one bad tenant or empty building doesn't sink the whole investment. But if the real estate market slows, like during the pandemic with empty offices, share prices and dividends can drop. 4-year performance example. A $100 investment in a popular REIT 4 years ago might now be worth about $99 in share value, a tiny loss, but you likely collected roughly $12 in dividends along the way. Total result, approximately plus 10% overall. Not spectacular growth, but steady income and less volatility than individual stocks. Third option, buying Bitcoin or Ethereum. Learning curve, moderate. You'll need to learn about wallets for digital storage, reputable exchanges, and basic security like strong passwords and 2-factor authentication. It sounds technical, but beginner apps have made it much simpler in recent years. Passive income potential, moderate. Bitcoin itself doesn't pay dividends, but you can stake certain cryptocurrencies like Ethereum to earn rewards for helping secure the network. Returns vary and come with extra risks like platform hacks or lockup periods. Tax efficiency, poor. Every time you sell, trade, or earn staking rewards, it's usually a taxable event. Crypto cannot be held in a Roth or traditional IRA in most cases. Risk level, very high. Prices can double in months or drop 60 to 80%. Scams are common. It's part investing, part speculation. Most experts suggest only risking money you can afford to lose completely. 4-year performance example. $100 invested in Bitcoin 4 years ago would be worth roughly $650 today, about plus 550%. That's impressive, but it's also not typical. Many other cryptocurrencies lost most or all of their value in the same period. High reward usually means high risk. Fourth option, investing in gold. Learning curve, low. Two main ways, physical gold coins or bars, but you need a safe place to store them, or gold ETFs, which are shares that track the price of gold and are bought and sold just like stocks. Passive income potential, none. Gold doesn't pay dividends or interest. You only make money if the price rises and you sell. Tax efficiency, good. Gold ETFs can be held in a Roth or traditional IRA for tax advantages. Physical gold rules vary by state and coin type. Risk level, medium. Gold tends to hold value during inflation or economic uncertainty, but it can stay flat for years while stocks grow. It's more about protection than aggressive growth. 4-year performance example. $100 invested in a gold ETF 4 years ago might be worth about $140 today, around plus 40%. Solid, calm growth, great for preserving purchasing power, less exciting for building wealth fast. Fifth option, low-cost index funds that track the whole stock market, like the S&P 500. Learning curve, low. You don't pick individual companies. You buy one fund that owns hundreds of America's largest businesses. Setup takes minutes on most apps. Passive income potential, moderate. Many companies in the fund pay dividends. You can choose to receive the cash or automatically reinvest it to buy more shares. Tax efficiency, excellent. Hold inside a Roth IRA or traditional IRA and avoid taxes on dividends and gains for years or decades. Risk level, low to medium. The market goes up and down in the short term, but historically the S&P 500 has averaged 8 to 10% annual returns over long periods after inflation. Diversification across 500 companies reduces the damage from any single failure. 4-year performance example. $100 invested in a broad U.S. stock market index fund 4 years ago would likely be worth around $180 today, about plus 80%. Reliable, boring, effective growth. Exactly why many long-term investors choose this route. So far, we've broken down 5 solid ways to put that first $100 to work. Individual stocks for potential big wins, but with big swings. REITs for steady real estate income without buying a house. Cryptocurrency for high reward excitement and high stress. Gold as a classic safety net, and index funds as the reliable, set it and forget it choice. Now let's pull it all together with a side-by-side look so you can see the trade-offs clearly. Learning curve lowest, gold and index funds, minutes to understand. Highest, individual stocks, months or years to get good. Passive income best, REITs with high, required dividends. Good, stocks and index funds from company dividends. Moderate, crypto via staking. Zero gold. Tax efficiency in a Roth IRA excellent. Stocks, REITs, index funds, gains and dividends grow tax-free. Poor, crypto with taxable events everywhere. Good, gold ETFs. Risk lowest, index funds thanks to broad diversification. Medium, REITs and gold. High stocks. Very high crypto. 4-year growth examples approximate based on historical market data. Broad U.S. index fund around plus 59 to 80%. Gold plus 40%. REITs often flat to modest gains plus dividends for total 10 to 20%. Individual stocks wild range from losses to several times over. Bitcoin/crypto massive potential, but equally massive drops possible. These aren't predictions. Markets change every day, but they show real patterns over recent years. Here's the motivational part. The real magic isn't picking the perfect investment on day one. It's starting, staying consistent, and giving time to work. Compound growth turns small habits into big results. For example, invest $100 today and add just $50 a month at an average 8% annual return, close to long-term stock market history. And in 30 years, you could be looking at over $75,000. That's the power of time, not genius picks. Question for you in the comments. What's holding you back from starting with your first $100 right now? Is it fear of losing it, not knowing which app to use, or something else? Be honest. Your answer might help someone else watching who feels the same way. A few practical next steps for U.S. beginners. Open a Roth IRA if you qualify, great for tax-free growth. Check current IRS rules for income limits. Many brokers let you start with tiny amounts. Choose a beginner-friendly platform with $0 commissions, fractional shares, so $100 buys part of expensive stocks, and easy index fund access. Look for broad market funds tracking the S&P 500 or total U.S. stock market. Start simple. Put most or all of your first $100 into a low-cost index fund. Add more whenever you can, even $20 counts. Automate it. Set up recurring transfers so investing happens without thinking about it. Learn as you go. Read one good beginner book. Watch educational videos, not hype ones, and track your progress once a year, not every day. Remember, no investment is guaranteed. Markets go down sometimes. That's normal. The goal is to own pieces of the economy long term, not time the ups and downs perfectly. You don't need to be rich to start investing. You just need to start. If this video helped clarify things and you want more step-by-step guides, like how to open that first Roth IRA, what specific low-cost funds many beginners choose, or how to handle market drops without panicking, let me know in the comments. Thumbs up if you're feeling more confident about taking that first step. Thanks for watching all the way through. Your future self will thank you for starting today, even with just $100.